Hi, I'm Rick Albert, and welcome to The Key to the City of Angels, the podcast where we unlock the secrets of Los Angeles real estate. With over 300 real estate deals under my belt, I've seen it all, from house hacking strategies that build wealth to helping clients close multi-million-dollar deals in one of the most competitive markets in the world. Every week, I'll bring you expert insights, market trends, and inspiring success stories to help you navigate the LA real estate scene. Whether you're a first-time buyer, an investor, or just curious about what it takes to thrive in the City of Angels, this podcast is your guide to making smarter decisions and achieving your goals. So grab your keys. It's time to unlock your path to prosperity in Los Angeles real estate. Hello everyone, Rick Albert here with another episode of The Key to the City of Angels. I am super excited here to have KC Chohan of Together CFO. Thank you so much for being here.
Hey Rick, how's it going, buddy? Thanks for having me on.
Yeah, absolutely. So we're going to be talking about different wealth strategies. And I've talked to other people as well, but what I love about KC is that he's local, right? So we can talk about what's happening really on a local level. But first, how did you get into this space? Because numbers isn't for everybody.
Yeah, it definitely isn't. It's a long story. I'll give you the short version so we don't bore
Okay.
everyone. But I didn't know what I was gonna do when I was at school and college. And one of the best pieces of advice my father gave me, God rest his soul, is that try different things. So every summer I would intern at a different place. And the one that I liked the most in the second year of doing this during college was an accountancy company. So it was my uncle's accountancy firm, right? So he wasn't as harsh on me as the other people. But at the end of I think it was 4 weeks that I did with him, he sat me down and he's like, son, I'm going to give you some advice. And it stays with me to this day, right? So this is like decades ago. If you learn and understand numbers, you can go anywhere in the world and have a good job and never have to worry about money, because he knew I wanted to travel. He knew my family. I know you want to get out there and see what the world has, but you also want to make sure you're comfortable and you're not having to go work in a bar or a restaurant to make ends meet, because you're not going to be able to live the lifestyle that I know you want if you're doing that. So understand numbers. It doesn't matter what language, it doesn't matter where you are in the world, because a number is a number. And I'm like, you know what? That's actually really good advice. So with that, it kind of led me into an accountancy, finance, business degree. Did that, and then I went into the world of accounting straight out of university and quickly realized that it wasn't for me. So it took me 6 months in the equivalent here of a CPA practice that was doing
Mhm.
bookkeeping and CPA services to think, what the hell am I doing here? It's so boring. I've, Within 6 months, I fully understood what I was doing, and I'm like, I can't do this for the rest of my life. So I quit, and then I went to save up enough money so I could travel the world for a year. Normally, in Europe, to take a gap year is pretty normal, either between school and college, or college and university, or university to the real world. There's normally a year that you can just, I'm going to go travel and see what's out there. So I wanted to
Yeah.
do that earlier, but I had a job offer before I'd finished university. So I took the job offer, and then it didn't work out. So I'm like, you know what? This is a sign telling me I got to go. I got to see the world. So I saved up enough money. I did some temp jobs. And then the last temp job I was at, I'm like, okay, guys, I've saved up enough money. I'm going to go traveling for a year. Thank you so much. And they turned around and they gave me a job offer. And it was as a management accountant, which no one had really told me the difference between an internal management accountant versus an external bookkeeper or CPA or an accountant. So I was like, you know what? It's not bad. The money's better than I was making. They're going to pay for my professional certification, the equivalent of a CPA in America. It's a win-win, right? I can do
Sure.
this. I can put on hold the traveling plans for this really good job. So 8 years later, I ended up having three moves, one international move. So I did 4 years in Europe, working my way up the ranks, and then transferred to North America, where I ended up in LA, and the rest is history. So 8 years in, I realized that I didn't like corporate America on the American side of the company. And this was a big $4 billion engineering company. So global, thousands of employees. Really, it was great. great learning environment at least, but culture was very different from Europe to America. But I was stuck because of my visa situation. So I had to stay with the company until I got my green card. And it was at that point I then quit and started my own company Together CFO, where we do fractional CFO services at the beginning until we pivoted the company. We had a great success with one of our first clients. We took him from 5 million a year to 120 million a year by
Wow.
adding the next vertical in. That created a huge tax problem for him. And then he pushed me to figure the tax situation out. And I was like, this is not what I do. I don't know anything about the American tax system back then, but he had more confidence in me than I had at that time. And it worked out pretty well. So we ended up saving him approximately 12 million in year one on taxes by what we call now the strategic giving blueprint. And I quickly realized that it was much easier to sell people tax saving services than CFO services. We pivoted the company and now we specialize, or since then, we specialize in helping create tax strategies for high net worth individuals. But as we mentioned before, a lot of people are high net worth and they don't even realize it. So
Yeah.
anyone I would say that has a company that's doing over 5 million a year or paying over 500,000 in taxes, it definitely makes sense for them to start optimizing their tax situation rapidly. But this is not at a loophole level. So everyone should be using the loopholes, whether that's the hire your kids, the depreciation, the write-offs, the office expenses, the travel, retirement accounts. There's a whole host of loopholes that are there and relatively cheap and easy to use. Everyone should be using them. But when you
Mhm.
start making more money and you into multiple seven figures, multiple millions, that's really where you need tax strategy rather than just basic loopholes. And that's where we come in.
Yeah, it's always interesting because I was told by one of my mentors, like, don't ever make a business decision based off taxes because the code changes. But I think it's almost like trickle down economics. Everyone's like a big fan of, oh, the wealthier paying this and that. But I also feel, and correct me if I'm wrong, we're at a point in our lives where there's a lot more money out there than there was before. Like whether trickle down economics, that's probably a whole nother debate of whether or not that's actually it. But it's like you get to a certain point whether, and Jeff Bezos is probably an extreme, but we'll use him as an example. It's like, yeah, he actually needs tax services because he's actually going to see those savings. So what have you been seeing in terms of like your clients were like, hey, we did need to go from that loophole. Now it's like we need to start building something bigger, if that makes sense.
Yeah, 100%. So when what the point at which we see that, let's say the loopholes run out is a three to $400,000 tax liability because
Okay.
there's only so much you can pay your kids as a
Right.
write-off. There's only so much you can travel. There's only so
Mm,
many cars you can buy and write off. So you get to a point where, unless you're having a kid every year and buying multiple properties every year, that you're going to run out of loopholes. And that's the point at which you need a strategy. And what we call it is a structure, because the structure you build and it can keep growing in perpetuity long after where we've gone, right? So we're
yeah.
building it for our legacy, which is where the strategic piece comes in. And we want to pass on our wealth to our future generations tax free. We don't want to pay 40% estate planning tax because we don't know if this new administration is going to reduce the inheritance tax down. There's talks it's going to go down to 6 or 7 million next year. Hasn't been confirmed yet, but it used to be 5 million. It went up to 13 and it's going to go back down. And then accelerated depreciation, it's a great example that it's been going down by 20% every year. And now they're pushing to bring it back into 100% with this new beautiful bill. So there's always going to be turmoil, things coming in, things going out. But if you don't have to worry about that because you've got this structure built that can handle it all as much as you want or as little as you want, and that's part of your family legacy, your asset protection, no capital gains tax, and down to a 1.4% tax rate. I don't know many better structures than that.
It's You brought up something interesting about this whole like, what is the limitation? And a lot of people are like, that's really high. That doesn't necessarily pertain to me. But then I remember it was on somewhere on Instagram, some of those like SoCal accounts, and they're like, oh, LA has like the most millionaires and versus any other state or something. And I was like, yeah. And normally I don't comment because I don't really care. But it's like, just so we're all clear, people bought these homes for $20,000 that are now worth 1.5 million. Like we're talking net worth, not necessarily money in the bank.
Asset rich, cash poor.
Yeah, exactly. Which I think there's a lot of like kind of misconception or like confusion. It's like, yeah, on paper I look great. Which,
Especially here, because like you
oh
can't
yeah.
get even an apartment building where I live here for less than $1 million. You take that million and you go to Texas and you're getting a huge 5 bedroom mansion with an acre. And it's, oh wow, it's very different.
Oh yeah. I remember I bought a triplex out of state. It was actually listed for 180,000. The seller was too lazy to install hot water heaters, which made it non-financeable. So it had to be cash. So we ended up negotiating it down to 90 grand. I just got a triplex for $90,000
Can
because he didn't
barely
want to
get a
spend
parking space
7,500
here for that.
bucks.
Yeah,
I'm like,
ridiculous.
that's, that's a down payment for a small house here. But you're right. And that's why I wanted to bring it up. It's just like when it comes to wealth building, it can happen very fast here. So what have been some of the challenges that you've been seeing, especially recently? Let's say over the last like 12 to 24 months that you haven't been seeing before?
So for us, I think a lot of it stems from the uncertainty.
Mhm.
People right now, the tariffs are huge, so that's impacting a lot of different businesses that import in or exporting goods. And the knock-on consequences, what is happening to our goods? Are we going to receive them on time? How much are we going to have to pay? How much of that can we absorb or do we have to pass on? How is that going to impact sales? And
Mhm.
it's a trickle effect. So it's trying to understand all of those implications and get ahead of the curve, which is tough because it's changing daily. And it's one day it could be a 50% tariff, and then the next day, oh, we're okay, we're zero now. And I went through all of this stress and turmoil and planning for what? Just so that you can flex on a country, just to negotiate, or
Yeah,
whatever's going on behind the scenes, because none of us
right.
really know. So we're
I
seeing a
agree.
lot of that right now. And then from a tax specific perspective, so many changes, right? So Trump is obviously pro business, which is good for the vast majority of us, generally speaking. But what does that translate into day to day? We don't know until all these bills get passed, right?
Right.
Prime example was the estate taxes plan. We know that he's already passed the no tax on tipping, but that doesn't really affect our clients because that's at a different salary point, right? So there's various things coming into play. And until they're signed and sealed, it's that uncomfortable uncertainty that nobody likes to live in that phase.
Yeah, it's funny that you brought up the tariffs because people have asked me about it because I know people are like it'll force companies to bring jobs back. I said, no, it means that they'll deal with the tariffs for 4 years because what if the next president doesn't care? And it's going to take 4 years to build anything here anyways.
Yeah, good luck trying to build a factory and get permits in California where we are. Like,
It's going to take
not
four
happening.
years.
It's not
Can,
happening.
can you imagine someone's, all right, they spend the 4 years, they build this factory just to find out the next president's like, yeah, we remove these tariffs. They're like, what? What would I do with this building?
Yeah, but this is like the top 1% again. He's
Right.
flexing and he's negotiating at, let's say, a Tesla or a Mercedes or be it like these big companies will
Yeah.
negotiate tax breaks or incentives or, you know what, we'll bring a factory back here and employ this many people if you do A, B, C, D and make it competitive. But the
That was
average
my thought.
person like us with average business is just going to crush you because most people, let's just say that someone creates these business cards, a nice little metal business card, right?
Mhm.
They can't compete with China on that. Like it's literally costing you 2 cents to make there. You've got to pay your employees $20 an hour here, plus healthcare, plus this, plus there's no way in the world you can compete on that.
Yeah. I will say on the real estate side, people are like, why is there so many wealthy people? I said, because you can have an entire team and not have a single employee. Yeah, the real estate agent, the lender, the property manager, the contractor, like none of them are your employees, but yet you can still build it. So, what are some of the tax strategies? What are some of the things that your clients are implementing for the basically to be for now, but then to your point of we don't know what's going to happen in the future, what are they doing to plan for that? Can you do stuff that's built in, or is it literally like day by day we have to make changes?
No, that's the whole point of being proactive rather than
Right.
reactive. So we always encourage to look ahead and plan ahead, and not
Hmm.
just plan ahead in terms of 5, 10 years, but multi-generational, because when we model what the elites are doing at a family office level or at a billionaire level, all these family offices, they all have multi-generational estate planning in place. They
Yeah,
want to transfer the wealth without it losing 40% every generation. And then
yeah,
also they want to teach the next generation how not to squander it, because the first generation makes it, the second generation maintains it to a degree, but by the third generation, it's gone.
I've heard the same thing. I was just about to ask that, so you already answered it for me. Okay, you're
Yeah,
ahead of
so
it.
that's a normal, common theme that we see time and time again. UBS does studies on this virtually every other year. Same stats come out. 70 to 80% wealth is dissipated by generation three. And how do you get around that? It's you plan now. So you create a strategic giving blueprint. You set up the structure that the assets go into so that upon your demise, there's no death taxes, there's no estate planning taxes. If you sell any of those assets, there's no capital gains taxes. You're not
Right.
forced into doing a 1031 exchange and still having no cash at the end of it because you've just flipped it into a bigger piece of real estate with a higher interest rate and a bigger risk. So
Yeah.
you don't need to do those tools if you've got a strategic plan in place and the right structures. And that right structure often tends to be a private foundation, 501(c)(3), private non-operating foundation.
Okay, let's dig into that. So you're saying that you get to a certain wealth, you create the charitable foundation, so the money's kind of funneled through it. Is that the idea?
Donated into it. So you get a
Donated
tax
into it.
write-off for
Okay.
donating the assets into the foundation that you fully control.
Okay. And then that money then goes to the charity. So basically you're saying like that's the way to funnel some of these tax breaks.
The money can stay in there. It can be deployed into assets, and a portion
Hmm.
of it can be given to charity. You don't have to give it all to charity.
Sure, because there could be operating expenses or however you want
Of
to
course,
to
yeah.
do it. Okay, that makes sense. And then on the property side, because I meet it's always like I see in a lot of forums, I talk to a lot of people like, hey, I'm inheriting this house. I want to keep it as a rental. And I'm
Hmm.
like, I'm all for keeping rental. That's how you build wealth. But then to your point, it's like when you sell it's tax free. So when in most cases it would actually make sense to sell it because it would take you so many years to make that same amount of cash. And then from there, go buy investments, do whatever. Have you had
So
those types of
I would argue
conversations?
differently. So let's just use a scenario, a hypothetical scenario
Sure.
that you're about to inherit a house, but your
Mhm.
parent hasn't passed away yet, right?
There's always that.
So let's just say before your parent expires, they donate the house to a foundation
Hmm.
that you are the board member of. Now
Okay.
they get, let's just say for ease of use sake, it's $1 million house that they put into the foundation.
Sure.
They get $1 million tax deduction on their tax returns. The foundation gets
Right.
the asset. The foundation now owns the house. It's worth $1 million. Let's say 6 months' time, unfortunately, your parent passes away, but you are still in control of that foundation. That rental income is coming in, and you're
Hmm.
only paying 1.4% tax rate on any of that net profit after expenses of the house.
Oh, interesting.
Let's say another six
Okay.
months goes by. Now the house has gone from a 1 million up to 2 million. You want to sell it. You pay zero capital gains tax because it's owned by the foundation. Now, $2 million
Um,
of cash comes into the foundation, and you're like, you know what? Maybe half of it I want to buy real estate. The other half I want to put into the stock market or invest in random companies, one through three.
yeah.
You can do all of that in the name of the foundation in a tax
Right.
exempt environment that you can then have your kids become board members in the future and control those assets.
But I think the big thing, because you mentioned how money doesn't usually transfer past the third generation, couldn't an argument be made that a lot of it just has to do with education? Like these,
It's
like they don't,
100%
right.
education.
So let's dive into that, which I know is a little bit outside of it, but it's like, how do you teach your kids? Because like I think when I'm thinking about it, it's like I'm trying to build my own, I call it my little empire, right? Like I own rentals. I'm up to about 16 doors. And what I intend on doing is as my daughter gets older, I'm going to have her on the calls when I'm talking to the property manager. And I'm going to have her on the calls when I'm talking to our real estate agents out of state. But so that way she sees the work that goes into it. But then I could imagine that in some cases, by the time you get to that third generation, there might be that disconnect.
100%. So this is how the elite families like the Rockefellers and the Rothschilds
Yeah,
do.
let's talk about it. I want to know how they do it.
They bring all family members into the board meetings for the foundation. Everyone sits in, they have a full retreat in Hawaii or wherever in the world. It doesn't matter
Well, yeah,
because
you
it's
might
all
as
right.
well.
Yeah, but literally every new family member, so that means whether you're marrying into the family, whether you're born into the family, everyone is there collectively. And this is where they talk over the agenda and the values of the family. What are we
Mm,
invested in? What do we like? What do we don't like? Why? And then the younger generations get to grow up in that environment, knowing, hey, every quarter we're going to have this meeting that we have to attend,
mm,
and we are going to learn something about our family. And that's how you go from building an empire like the Rockefellers or the Rothschilds versus an empire like the Vanderbilts that
hmm.
crumbles because they just spend it all and they don't invest it wisely because it's gone by the third generation.
Yeah. Yeah, it's also like they just were never taught how to keep track of it. They were just never. Some people, you do have like the Jeff Bezos, Elon Musk. I don't know how. I guess the money could run out at some point, but when you have trillions, it starts to become a totally different animal. But the meetings are interesting. I guess I never really
So
thought
we'll
about.
use that as an example because
Okay,
there's a
let's do
current
it.
example we can talk about, and it's Warren Buffett. So Warren Buffett has just donated $9 billion to his three kids, giving them 3 billion each, completely tax-free, because it was a donation from his foundation to his kids' foundations. So
Interesting.
this is how they move money from one level or one generation to the next by a
Mm.
donation to the foundations.
So when we hear about high net worth people doing these charitable donations, but they don't go into details, is this usually what they're referring to, or are they referring to actual, I don't want to say actual charities, that's not really fair, versus like external charities, we'll call it.
The difference is public versus private.
Okay,
So
good. That's a good way to look at
if
it.
you're going for a public operating charity, something like the Red Cross that everybody's heard of, right?
Sure.
That is soliciting donations from anyone. You can put money in, I can put money in, our neighbor can put money in. But if you're a private, non-operating foundation, you are not soliciting donations. It's one member or one family or a close number of people that are only donating into that foundation. And that's the key difference. And that's what
Hmm.
all these billionaires have. And that's what not many professionals are well versed in. So if you go to your CPA and you ask him, hey, how many private, non-operating foundations do you file taxes for every year? I would be astounded if the number was higher than five. It would probably be
Hmm.
zero for the vast majority of people.
Sure. Yeah, I would think that it'd be a red flag for auditing. You would
It's
think.
actually the opposite. So, and I'll tell you why.
Go for
So,
it.
the reason why foundations get audited a lot less than corporations, LLCs, S corps, and C
Hmm.
corps, is because a lot of the information is public. So when you file your tax return as a foundation, it's on in the public domain. You can go search, you can Google
Mm,
Bill and Melinda Gates Foundation, and their tax return will pop straight up. So there's a level of self-administration there. So they don't feel the need to over audit. And it's actually
mm.
audited 90% less than an LLC that's making over
Oh,
$1 million.
interesting. I guess that makes sense. So look, we can take a look at it anytime we want. versus these other entities, we may not be able to. So we have to, it's almost like they're being forced to dig deeper because it's more private.
100%. So the
Yeah.
fact that you have to disclose everything, and there's so much red tape. So there's so many rules, procedures you have to follow to keep the tax exempt status active and in
Mm,
good standing. And that becomes the harder part because there's all of that compliance. You mess up on one thing and you can lose your tax exemption status. So nobody wants
mm,
to do that.
sure. And how expensive, generally speaking, is it to manage one of these from a
It depends on
paperwork?
how many assets are in there. So if you go to, let's say, a single family office, they're going to charge you in the region of about $5 million a year to operate the family office. So
Got it.
that's pretty expensive. So you need to have a net worth about 50 million plus to even justify that.
Like,
But
got
as you
it.
go down the kind of threshold to the big boys to a boutique firm like ours, we can get
Sure.
a portion of that family office feel in the strategic giving piece. As little as 50K on average, 50 to 150K can get you up and running very easily.
Which, in the big scheme of things, you're saving at least that in taxes.
You would save more than that year one, so you'd be positive ROI year one. Otherwise, it doesn't make sense. This isn't
Right.
for everybody. Do the
Sure.
loophole level stuff first, which is what we talked about at the beginning.
Yeah.
And then if taxes are still causing you a problem or a burden, that's where you can escalate into a more serious structure.
Yeah. Okay, that makes sense. So then how do you scale to that point? Right?
That's
Like,
that's the business, right? So let's just say that
yeah.
let's just use real estate, seeing as though you mentioned 16 doors. So when you go
Yeah.
from 16 doors, let's just say on average you make 10 grand net profit across
Mhm.
as an average, right?
Sure.
So you make 160,000 a year passively. Fantastic, right?
Yeah.
That could all be taxed at 40% if it was in California.
Right.
So that's ridiculous. Or
Right.
it could be taxed at 1.4% if it was put in a foundation with
Interesting.
no capital gains tax, with no 1031s needed. So it gives you a
Hmm.
lot more flexibility. So now at 100, let's just do the rough math. So if we go, what did we say? We said 160 times 40% is 64,000. Just call it 60,000. So you'd be left with
Yeah.
$100,000 of profit that after tax.
Right.
Versus if you paid 1.4%, you're left with $150,000 profit. So it's 100K more if you're structured in the right way. So
Yeah.
even at that level, at 16 doors, it makes sense if the long-term play is to keep growing the passive real estate.
Because I think that's what it's, especially for a lot of like the listeners, they tend to buy these buy and hold properties. Like because I've talked to some people about flipping and I'm not opposed to it. I'm looking into it myself, but it's like flipping can make you rich, but it doesn't make you wealthy, right? Because you're getting the cash one at a time. It's the passive income. You really need to figure out ways to make your money grow without you having to work as hard.
Yeah, that is exactly the difference between being rich and being wealthy is that when you're asleep, your money is making you more money.
Yeah. Yeah, I think the joke was like if Bill Gates dropped $100 bill behind him, it would cost him more money to turn around and pick it up. Because he has so much, which I'll be the guy behind him picking it up. I don't have a problem with that. But no, that is interesting. So then diving more into this, especially in LA, with a lot of the clients, are they even investing in real estate? Is that a big part of their portfolio? Is it more of, hey, we're doing this for tax purposes? Because I hear that all the time. Is we buy properties for
Most of
tax
our
purposes.
clients are coming to us because the taxes are killing them. They're about
Yeah.
to exit an asset, whether it's real estate, whether it's business, whether it's stocks, and they don't want to pay capital gains tax, or they've got a really successful business and it's doing 5 million plus and they're getting crushed every year on taxes. And we're like, you can do one of these three things and it'll help you reduce that down. And ultimately, you're paying the government money because you're not prepared.
Hmm.
And if you prepare yourself better, and it doesn't have to be with us, it can be any one of these loopholes that we talked about. And then
Sure.
when they run out, look for a more sophisticated strategy. But because you are relying on a CPA once a year who does not have your best interests at heart, it's costing you money, which ultimately is costing your family money and your kids money, and your legacy every single year is now diminishing on top of inflation, on top of everything else, right?
Yeah.
Because you're too busy doing other things, and you only need to set it up right once to save hundreds of thousands a year.
Yeah. Yeah, that's always kind of like the big thing. Like I've outsourced certain things and people are like, why are you outsourcing this? Or outsourcing, I'm like, because my focus is real estate. This is what I'm good at. That's why you have other people to do things
You
for
need a team,
you.
yeah.
Yeah, it's a deal. And I have clients who use me as part of their team all the time. We evaluate the properties, determine to sell it, keep it. And funny enough, I've done, and we can talk about it later, but I do a lot of equity reviews where once a year I sit down with my clients and with people I know and say, hey, this is what your house is worth. I'm not saying you should sell. This is just we just need to get a picture of what's going on. And I've done about a dozen of them so far this year for clients and friends. And so far, most of them like you shouldn't sell. You actually should keep it. And I've had other clients, I'm like, yeah, dude, you should sell. Here's why. There's always a variety of reasons. But you just got to take the time to do that kind of stuff, to have those reviews.
It's being proactive versus being reactive. And
Right.
the point I want to make on that is the team that's got you where you are right now is not the team that's going to get you where you want to be in the future.
Yeah,
And
things
people often
change.
overlook that. Like they really do, because if you're at a startup and you're just scrapping around to get to the first million, fantastic. You can do that on your own relatively easily. But to go
Yeah.
from 1 million to 10 million, you need a team. There's no way you're going to do that on your own.
Yeah, I totally agree. Because we can't know everything. ChatGPT only goes so far.
Can't know everything, but we don't have the time or the mental bandwidth to do everything either.
Yeah. Oh, I agree. It's one of those things where like you have to start delegating. And I've even noticed that. Or people are using artificial intelligence, but then you have to ask it the right questions in order to get the right answer. And I think that's where some of the challenges, but if you don't know what the question is, like I have a client, she works in marketing for a big pharmaceutical company, and I asked her, I was like, hey, look, with artificial intelligence, are you out of a job? Because it can create a whole marketing plan. She's like, for some people, yes, but you need people on your team that know what questions to ask it in order for it
Prompt
to produce what you
engineering,
want.
right? It's now
Yeah.
you gotta be the prompt, and you don't need to be the coder anymore because it can code for you, but you need to
Hmm.
tell it what to code and how to code it.
Yeah. Otherwise, it's just a Google search. It's kind
Which
of like the
prompt
big
engineers are
difference.
getting paid a fortune now as well. So we recently created a software called financialfusion.io, and it's an AI CFO that
Okay.
plugs into your QuickBooks or whatever you're using and literally acts as a CFO for your business that you can ask questions to, build
Oh, that's cool.
forecasts, do budgets, and literally that's gonna not replace CFOs, it's gonna make them more efficient, and it's gonna help bookkeepers upsell to a higher level service, and it's gonna help busy entrepreneurs have a CFO literally on their phone.
Yeah. I think that's what, at least a lot of people I talk, that seems to be like the biggest component of what they need on their team is some level of a CFO, whether it's because they've never managed that kind of money before, or when you, to your point, you get to a certain level, like if someone gave me $100 million, I'd be like, yeah, I need help with this. Yeah, I could figure it out. I could buy real estate. I could do it, but if you want to be real strategic, you need someone who understands that level.
100%. Yeah, back to team, right? It's the team that you need a team that can operate at $100 million level, not your local CPA that's been with you from day one that can operate at $100,000 level. No disrespect to the $100,000
Right.
level, but you just need more knowledge and specific knowledge at the level that you're at or going
Yeah.
to.
Right. You have to be in that world. Is how I usually call it, right? Like I work with a lot of investors. They want to work with a real estate agent that also invests. Because when they don't, then they start asking questions the person can't answer. You need someone at that level. You know?
100%. Yeah.
Yeah. This has all been like amazing. What are some like big takeaways people should be doing when they're at the loophole level, but they want to get to that big time level? What should they be looking at? And I know like every business is different, but even from a tax strategy, asset protection, which we can actually go into next because I have some questions there. But yeah, so what are like some things to consider?
So it's looking at your numbers and understanding them, right? Because if you're on course to do, let's just say 5 or 10 million this year, you're going to have a huge tax bill. How are you planning for that? What's the cash flow implication look like? What's your working capital cycle in the business? Like, do you hold inventory or cost of goods, or do you need more labor? Like, you need to factor in all these external factors on top of the growth, on top of the trajectory. Because if you're catching a good wave in the market, a lot of people sold so much furniture during COVID because everyone was at home, right? Garden furniture specifically. Now, that was okay for 2 years. But then when COVID's over, you're not going to keep selling the same amount of goods
So
and you're
many
going to get
companies
caught out.
drop the ball in that.
So many. And a lot of my friends did too. So it's like understanding the cycles in business, being proactive so you can see them coming, not reactive, because being reactive is going to cost you a hell of a lot of money than being proactive. So that's the big one. And then educate yourself. Don't just trust what your CPA says. So we've got the top 50 loopholes that everyone should be using in a simple list in our school community, available for anyone to come join for free and download and send to their CPA. So what I actively encourage is people to take that list, email it to their CPA and say, hey, how many of these have we used? And
Hmm.
then instantly you can see how good your CPA is. When was the last time you rated your CPA to see, hey, how good are you? Do you know what you're going on about? And now maybe, Rick, your CPA is a specialist in real estate or investing because
Hmm.
you're doing a lot of real estate specific things. So if you're doing a cost segregation or if you're doing a hub zone investment, you're going to differentiate that from a regular CPA on the high street who doesn't know how to categorize those things, right? Or how to
Right.
make sure you're reclaiming depreciation, or if you're selling it, what's the calculation? Because you've got to do all these extra steps depending on what your speciality is. So make sure you're working with the right type of professional, at the right size, with the right industry specifics as well. And we get a lot of referrals from CPAs because they are not experts in the charitable world. They may be good or they may be average in the loophole world, but they know
Hmm.
what they don't know on the charitable world. And they're like, we don't want to get involved in this. You guys are the experts. You do
Yeah.
that. And it's great for us because we stay in our own lane and we specialize in our own lane. So we don't have to threaten them by taking their clients because we're like, no, we'll do the strategic giving piece. We'll show the
Hmm.
client how to save a minimum 32% on top of the loopholes that you should have already run them through. And if you haven't, we'll show them some additional loopholes, not to show you up, but we want the client to get the biggest saving. We don't want the government to overcharge. And that's
Right.
ultimately what's happening. Because when we look at the stats, I think it's 82% of people overpay on taxes because
Mm.
they just haven't been proactive.
No, they use TurboTax. They just do the taxes themselves. It's just
That would be the worst thing to do, but yes,
oh my
it
God.
happens.
I always have worked with a CPA or someone and people are like, can't you just do it yourself? I'm like, I could, but why?
Yeah, if you're a simple W-2 and you have no other deductions that you could possibly take,
Yeah,
maybe
maybe.
maybe I could see a reason to do it. But other than that, I can't justify it.
It's like for a couple $1,000. So I know as you get into bigger profile, it becomes more expensive. But we'll say for a low percentage, right, of wealth versus tax, like why wouldn't you? It just makes more sense. It'd be interesting to send the checklist over to your CPA. How do you address it where you're telling the CPA how to do their job? So how would you approach like, hey, I received this, I found this checklist, do we do everything on it? Versus if I'm a CPA, I'm like, dude, I know what I'm doing. Why are you sending me this checklist?
Prove to me that you know what you're doing because I want to see it. And it's quite simple. I'm the client, and
Right.
show me that you're worth your mustard because if you're not and you don't do this, it's a sign to me that we're missing a trick. Because all I've got to do is go to the next CPA and say, hey, check my returns against this list and tell me what I was doing and what I wasn't doing, and you'll get a new client because of it.
That's an easy way to do it.
Really easy way to do it. Yeah.
Yeah, or maybe ChatGPT, just load up both and say, all right, which ones have I actually capitalized on? So let's shift gears a little bit to the asset protection because you brought that up a few times and it's super important. But I've never really talked about the asset protection from the charity perspective. So can you dig into how that operates?
Yeah, so asset protection as a whole, it comes down to two kind of main fundamentals: ownership versus control. So ownership, control. If
Okay.
you own the asset in your name, then that's going to create taxation. So let's just use a house, seeing as we've been talking about
Sure.
real estate.
Yeah.
If that house is in your name, and now let's say you get a second house, right? And something happens to house one, and they're not going to just sue you for house one. They're going to sue
Right.
you for the combined value of house one, car two, anything that's in your name.
Mm-hmm.
And that is what the lawyers, these ambulance chasers, called a settlement value. They'll tot up all the assets that you own, they'll put a number against it, and they'll say the percentage that this case will end in our favor is this, and that is our settlement value. The net assets times the percentage equals settlement value. Now, if there's no assets in your name versus two houses and two cars in your name, instantly the settlement value is zero because anything
Mm-hmm.
times zero is zero. So the trick is to have nothing in your name. You want to be a ghost. Now, if you can achieve that on paper, you're great, you're golden. But there is some other things you have to take into account. As an example, if you're buying houses, you've got to be bankable. Be bankable. Banks are now saying, we need to see your tax returns. We need to prove that you're paying these taxes so we know that this investment that we're going to make in you is going to be a good one. Or you're going to
Yeah.
go alternative route for money, hard money, might be a little bit more. There's ways around that. But generally speaking, if you don't have any assets in your name, then that's the best way to do it. And if they are
Sure.
owned by a foundation and are controlled by you, then what is the difference?
Oh yeah, on a day-to-day practical basis.
And this is the biggest thing that we have to articulate to our clients is to get comfortable with the difference between ownership versus control. And if you
Mm-hmm.
can really get to grips with that early on, the foundation will be amazing for you.
Yeah.
Because this is a tool that you can now donate the Ferrari into and then pass that on to your kids and their kids and so on, and then sell it at Sotheby's auction for $25 million because it's so rare and pay
Right.
zero capital gains tax on, but enjoy all the way down the lineage.
Yeah. Oh, very nice. Okay, that makes a lot of sense. All right, Casey, this was amazing. I really appreciate it. I will probably have you on again soon because as laws change, then
Yeah,
strategies
happy to.
change. It's like that's always it depends. So how can people get a hold of you? What should they be looking for?
Yeah, so Together CFO is the name of the company. So you can go to togethercfo.com on the website or Instagram, YouTube. We've got loads of content on YouTube as well if you wanted to learn more about private foundations and generally wealth and how the elites operate. That's probably the best way to do.
Oh yeah, dude, I'm watching all of them. It just sounds like interesting, right? Because there's a reason why wealthy people are wealthy. And it's not the money they spend, it's the money they save, it's all about strategy.
And mindset, right? They don't teach you this in schools, right? This is taught around the dinner table and the private foundation boardroom
Right
meetings.
now that I have to have my own boardroom now,
100%. And this is
right?
where it's taught because when you go to schools are just there for you to pass a grade and move on to the next grade.
Yeah.
It's creating employees, it's not creating thought leaders, and it's
Yeah.
definitely not creating generational wealth. So we have to
Yeah.
do that as parents, as leaders
Yeah.
for ourselves because if we don't do that, what is the point of working so hard and building a mini empire or a mega empire
Yeah, no
if you're going to
kidding.
give half of it away to the damn government?
Yeah. Yeah. Totally agree. Totally agree. Casey, thank you so much for being here. Thank you everyone for listening and watching, and I'll talk to you guys soon.
All right, thanks for having me. Take care.
Thank you. Thanks for tuning in to The Key to the City of Angels. I hope you found today's episode helpful as you navigate the world of Los Angeles real estate. Whether you're looking to buy your first home, expand your investment portfolio, or sell in this competitive market, I'm here to help you succeed. Let's connect. Visit my website or follow me on social media to learn more about how I can help you achieve your real estate goals. And if you're ready to take the next step, don't hesitate to reach out. I'd love to work with you. If you've enjoyed this episode, be sure to subscribe, leave a review, and share it with someone who might benefit. Together, let's unlock your potential and make your real estate dreams a reality.